Get daily investment news you can use.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Monday, post-Super Bowl day, so you're probably not even awake yet because I don't know about you, but that game was a good game, but way past my bedtime. But anyway, I watched the whole thing though. My son up at 8 a.m. He was rooting for the Chiefs, so I said I'd take the other side of the bet just because, right? So I took the Eagles. Yeah, he owes me $40. So, which is funny because I have to send him money so he can buy groceries this weekend. So he's just have to send it back to me now. So anyway, it's all good. Now, of course, we've got to talk about the Super Bowl indicator because that, of course, is kind of cool, right? There is, if you don't know what the Super Bowl indicator is, there's a kind of an old Wall Street axiom that depends on who wins the Super Bowl. It used to be, the AFL and the NFL, and then after the merger, it became NFC versus AFC. But the thesis is that if the AFC wins the Super Bowl, then you typically have a negative year. And if the NFC wins, you typically have a positive year. Now, what does the Super Bowl have to do with the stock market? Absolutely nothing. We've talked about causation and correlations and those type of things, but there is a coincidental kind of analysis that goes along with who wins the Super Bowl and what the outcomes are for the markets. And there's about a 75% accuracy rate that if the NFC wins, you typically have a bullish year for the markets. Now, again, it doesn't always work out that way. The Chiefs won the last 2 years. That was correct the first year. The AFC won The Chiefs won 2 years ago, and we had a down year. That was 2022. But they won also last year, and you had a 20% gain, right? So, or the previous year, and you had a 20% gain. So, they're not always accurate. Again, it doesn't have much to do with anything, kind of going on in the world. But congratulations to the Eagles last night. Well played game. But hopefully that will now translate into a bullish year for the stock market. At least that's what stock market investors are hoping for, right? So we had the first 5 days of January were positive. We have the January barometer was positive. So goes the month of January. So goes the year. Now we have the Super Bowl indicator. All things are looking up for the stock market, which means that probably something terrible is going to happen. So we'll just see what happens. Other big news today, of course, is over the last few Mondays, right? We've been kind of dealing with turmoil. 2 Mondays ago, we had the whole deep-seek sell-off in the markets, right? Markets were roiled by that whole concern over the Chinese AI. Last Monday, we had the market sell off because of tariffs, right? And so that was, markets kind of worked through that for the week and then rallied back. And interestingly enough, despite these sell-offs that we've had, the market has rallied back, following that news. And then on Fridays, going into the weekend, we've been selling off and then, of course, have a down opening on Monday and the markets rally back. That's kind of been the pattern here over the last couple of weeks. This morning, the markets are going to have to deal with a potential announcement that tariffs will be implemented on steel and aluminum. If you're English, just have to throw in some extra syllables, I guess. So maybe we should tariff syllables. So there you go. You want to throw in extra syllables? Tariff those. There you go. Exactly. So, but yes, aluminum will be tariffed potentially today. We'll see what the Trump announcement is later on today, see if that happens. But that could potentially, impact markets a bit. Again, when we come back to talk about these tariffs, it is, simply a function of stick and carrot. And we've seen this now over the last, really couple of weeks between Mexico as well as Canada. It doesn't mean tariffs are completely off the table. We're still going to have to potentially deal with some form of tariff as we go forward. But it's also important to remember that it's not just us tariffing other products, right? A lot of people just kind of assume it's like we're the only country that's got tariffs. No, U.S., and this is one of Donald Trump's positioning, is that the trade balances between countries are not equal. There are other countries impose tariffs on our goods and services that we export to those countries. And so he's just basically saying, look, if you're going to tariff or to tariff you, it's all fair in love and war. And so this is just simply the stick and carrot negotiating, but it is going to provide volatility to the markets potentially as we go forward. So having said that, let's talk a little bit about the markets. Here's what you need to know before the bell this morning. We did sell off just a little bit on Friday. And again, this has been this kind of pattern here over the last couple of weeks. And importantly, despite the fact that, markets keep rallying back, we are kind of setting some lower highs here, which is a little bit, a little bit, cautious here. But we do have a kind of a declining trend channel that's being built here by the markets. Lower highs, lower lows. Markets rallied to the top of that trend channel on Friday, failed, and then we'll see how markets are going to do this morning. Futures right now pointing up a little bit this morning, so right now, at least out of the gate, we're kind of expecting a little bit of a rally here. But again, we continue to hold support in the markets. Money flows continue to be very positive, so that's helping support the markets. But despite all of this, kind of news headlines that we've seen, again, there's certainly a lot of reasons to be cautious, be bearish at this point. I mean, just the headline flow alone has been very disturbing. Our earnings, we're about 80% of the way through corporate earnings. They're going to start to lighten up a lot this week. Good news is corporate buybacks. That window is now fully open really by the end of this week. So we're going to see corporate buybacks really starting to come back to work here. But despite all of that, right, markets just really have not done a lot. We just kind of remain within this trading channel. And it's been a little bit frustrating because it's like, well, the markets, markets aren't really going anywhere and I'm not really making any money. And, It's really volatile, and that certainly weighs on investor sentiment. Again, and we talked about, the psychological pressures when we go through consolidations like this. It does weigh on that kind of investor mentality, and this is what kind of leads us to make mistakes sometimes. Is going through these types of periods. These are healthy periods in the markets. We're just consolidating some of that previous run that we had in the market last year. We had a very big return. Not surprising, the markets are taking a bit of a break here. But importantly, there's nothing really negative going on just yet. So again, despite kind of this churn and grind that we've had, the markets continue to remain in a nice uptrend. You're holding support levels at critical points. The one thing to kind of pay attention to, though, is that you're very close to triggering a short-term MACD sell signal that could, apply some downward pressure to the market here, at least temporarily. But again, markets should maintain, kind of this, consolidation range, this kind of support range that they're in, as long as these money flows remain very positive. And money flows have been very, very strong over the last couple of weeks. And again, as buybacks come in, that should provide some additional support. Markets aren't really overbought to any great degree. So again, there's nothing, really kind of outside of what's going on in the markets other than this consolidation process. So it's kind of one of those times you just got to be a little bit patient here. Sometimes, when things aren't really kind of moving, we feel like we have to do something. And sometimes doing something is kind of the worst thing to do. So when you're kind of in these periods, sometimes it's just best just kind of sit and wait and kind of fight those urges to do something, because again, that typically turns out to be wrong. Again, this market could very well kind of get its act together here, work off some more of this this overbought condition, and then kind of set up for the next rally. We're still in the seasonally strong period of the year. February tends to be a little bit weaker month, but March, April, May wraps up that seasonally strong period of the year. So again, the bias is to the upside. So again, be a little bit cautious here about trying to do something just for the sake of doing something. Be strategic about your investments, pick your spots and let the markets kind of help you get those entry points. But that's what you need to know before the bell this morning. We'll come back. We've got a lot of this stuff to get into today, so don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday. But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So on Friday, I had to fly out to Vancouver to go. I was the keynote speaker for the Money Talks conference in Canada, World Economic Conference in Canada in Vancouver, which is kind of a really beautiful place. If you've never been to Vancouver, it's very pretty. It sits on, kind of the leeward side of a mountain range. On the other side, about 30 minutes away, is Whistler. But they never get snow hardly. Snow is a very rare thing. And it was interesting because I get there and there's snow all over the ground. And I was talking to my dear friend, Michael Campbell, who runs the Money Talks conference. He and I were talking. He's like, yeah, we never get snow here. And I said, well, Houston, we got a lot of snow this year too. So kind of one of those strange years. But, we had a very long conversation, and it's very interesting when you talk to somebody from another country that has lived there their whole life. And he's very involved. His brother was the prime minister at one point, and, so forth and so on. So he knows a lot of people, and a lot of things are going on. And we were talking about healthcare, and because, a lot of complaints here in the States, like our healthcare is so expensive and, et cetera, so forth and so on. And generally, people don't understand the quality of the healthcare you have here versus other places in the world, and how good your healthcare is. Yes, it is expensive because we decided to do stupid things like put government in the middle of it with the Affordable Care Act, which just drove costs through the roof. But it's still the best healthcare in the world, period, hands down. And, a couple of interesting stories. My son is a good example. He lives in the UK because he thought, when he was young, he says, I'm going to go live in Europe because everything's free. I can go to free college and I can get free healthcare, and this is awesome. America sucks. And I'm like, okay, well, go find out. And so he lived in Germany for a while and found out, it's kind of the FAFO, thing that you learn. Had to learn it the hard way. Lived in Germany for a while and figured that one out. So he moved to the UK. Well, anyway, he called me the other day and he says, man, I'm trying to figure something out here. And I'm like, what? He says, well, he's got a problem with one of his molars, right? Because he was 18 and now his molars are coming in and very painful. He's having a very painful incident with his molars. I said, well, go to the dentist. He says, well, I called the dentist and they can't see me until May. This was end of January, right? So, he says they can see me in May. And I said, but I'm really in a lot of pain. And he says, can't you get me any sooner? And they go, yes. If you have private health care that you pay for, we can get you in next week. And he's like, what do you mean private healthcare? It's like, well, yes, we have two healthcare systems in the UK. You have your public healthcare system, which we'll get to you when we can. And then you have private healthcare that you pay for, which is expensive, but we can get you in next week. And so he's now trying to figure out how to pay for private healthcare. And I go, this is what I was trying to tell you. So anyway, back to my story about Michael Campbell. Michael Campbell's a great guy. Very, very smart, very intelligent guy. Anyway, big golfer, loves to play golf, but he's getting older now, and so he was out playing golf with his wife, who's a much better golfer than he is, and he hit his ball into a little creek bed, and so he walked down to the creek bed to get it, and you can see the ball laying right there in the middle of the creek bed. It's just slightly below the surface of the water. So he stepped down into the creek bed, and unfortunately, there was a big hole right where he was stepping in that creek bed. So he immediately sank up to his thigh, and he fell. And when he hit his arm, he sliced his arm all the way up the side of his arm, very deep gash all the way up his arm. And he had immediately called the doctors, and he's like, when can you get me in? It's like, we can get you in 6 weeks. He goes, I'm bleeding all over the place. He's like, we can get you in 6 weeks. And so he called his brother, who was the former prime minister, who made a phone call, got him into the hospital the next day to get 27 staples in his arm. So now that's not the worst case of this. The worst case of this was he also contracted a bacterial virus from the creek bed, which then got into his system and caused whole other problems that he was going to have trouble getting medical care for had it not been for his brother intervening once again. So it's good to know people in high places when you have a healthcare system like this. But he was explaining to me all the horrors of the healthcare system. 17,000 Canadians died last year waiting to get medical care. So the point of the story is that, yes, we have expensive health care because we've inserted government into the middle of our healthcare system, and that has caused health. And again, we go back to the very basic premise. The biggest flaw with the Affordable Care Act was putting people with pre-existing conditions into the same pool as everybody else. That immediately drove your premiums through the roof, and that's why your health care is so expensive now. We used to have pools for people with pre-existing conditions. They were in a high-risk pool. You separated that group out. Their premiums were higher. Your premiums were lower because if you have to understand the basics of insurance. You pay in, and the goal is you pay into this pool of funds that when somebody gets sick, they draw out what they need. But hopefully there's a period of time for those funds to build up, that pool to build up. So as people need it, they take out what they need, but the pool is funding itself. Well, immediately, if you put a lot of people into the pool that have an immediate need, there's no time for those funds to build. And that's how insurance pools work. And so by combining these people into the same group as a healthy pool of individuals, it immediately inflated the premiums. But despite the fact that we have very expensive health care, it's still the best health care system in the world. And if if you don't believe me, go live in another country. I've lived in about 20 countries around the world. And let me tell you, having needed health care in other countries, there's a reason I live in the United States. And will continue to do so, particularly as I get older. But this is kind of always the issue that we miss in doing analysis. And we hear things in the media, and it's not just, and I'm using healthcare as an example here just because I have a couple of real-time cases to talk about. But it's not just that. It's also all the other things that you hear on television. And when you hear things from the media, you always have to remember that there's a bias to it one way or the other. And so it's always important to kind of dig down into the facts and start to kind of understand it. And really, and it doesn't matter what your opinion is, you can do and you should just do the research yourself. And whatever conclusion you come to is fine. There's nothing wrong with that, right? But, as investors, and this is one of the things that we've got to be careful of, is as investors, we've got to make sure that we're investing on the premises of the right information. Good example, Friday we had the employment report. Employment report comes out, 143,000 jobs. Last 2 months saw an upward revision of 100,000 jobs in total. So stronger employment growth remains strong. The unemployment rate dropped to 4%. Fantastic. Until you look at the numbers, right? And once you dig into the numbers, you find out, there was a huge revision to all the employment data last year. And on average, you kind of look at the numbers, the employment we thought we were getting was revised down by about 600,000 jobs a month. So a huge negative revision to all the employment data last year. So employment wasn't nearly as robust as what everybody was thinking it was because of the data. And then there's been this huge gap between the household survey and the establishment survey of employment. And the establishment survey has been saying one thing, and the household survey has been saying that employment is much weaker than what the establishment was saying. That was corrected in one fell swoop. And ironically, there was this massive upward revision of just enough jobs to make sure that establishment survey, that the household survey now matches the establishment survey. So how did you get to that number, right? Well, you just subtract one from the other and you put in the difference and say, there's your plug. So again, what does that tell you about the strength of employment? It doesn't tell you anything, right? And, now there's calls to Elon Musk to start investigating government data because none of this data makes sense. So it's very hard to go make economic assessments and saying, the economy's doing fine, we're all doing great. Wage growth is declining. The number of hours worked dropped to 34.1. That was one of the lowest levels of hours worked that we've seen in years. So, okay, great. You're making money. You're just not working as many hours, right? So this is the problem with the data. So again, as we start making assessments about the strength of employment, the strength of which, look, let's go back to the very basic premise. And part of my talk at the conference was talking about the production cycle. So we have to work first in order to earn a paycheck, and before we can go consume something, we've got to get paid. Then we go consume something, which generates earnings for businesses. Well, if I'm working less hours, I'm making less money, even though I'm full-time employed, quote unquote. I'm making less money on an hourly basis, which means I have less money to spend in the economy. And so employment's a very important factor of what drives earnings growth in the future. And what we're witnessing is we're seeing much weaker economic data that doesn't really comport to what we're seeing in the headline data. Now, this doesn't mean the markets are about to crash. It doesn't mean anything like that. But the important point about this is to step back and take narratives, right, and analyze these narratives for what's actually happening underneath to make a better assessment about where to invest capital and what to expect. Because again, at the end of the day, this all comes down to just one very important facet, and it's all about earnings. Can companies continue to grow earnings at a rate that are going to support valuations at some of the highest levels on record? That's the big question. So anyway, come back. Got some other stuff to get into this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife likes to open up the house. She had this idea that said, hey, can we just put a little black fence around the porch? And you have to submit all this to the HOA.
The Real Investment Show podcast.
They sent back this letter. The fence is disinharmonious with the neighborhood. Not disharmonious, not inharmonious. We had to get it all in there. It was so inharmonious that we had to do disinharmonious.
That's our word for the day.
Yes, disinharmonious.
Same show, your schedule.
So what are you going to do?
We're doing put bushes up.
And then put the fence up.
And then put the fence up. I could just say it was there to help the shrubs. Good idea.
Topiary support.
Topiary support. I like it. I like this a lot, actually.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, a funny story real quick about my trip to Canada. We were taking off from, apparently this is getting to be a thing because I've now heard this twice just lately. But as we're taking off, so I flew out of Hobby Airport to go to Dallas and then had to connect in Dallas to get to Vancouver. And as we're taking off, the pilot goes, "Look out your right side window. You will see the Gulf of America." And this is the second time I've heard people doing this, but it was funny. Everybody cheers. Everybody's all happy. But anyway, I got into Canada, and you've got to. So when you fly to Vancouver, you go through customs in Canada. And so as I landed in Canada, I walk up to the Border Patrol agent, and he looks at me, and I look at him, and he looks at my passport, and he says, "Why are you here?" And I said, "Well, I'm not being deported." And I've never seen a Border Patrol agent smile before, but he actually laughed. So, and he goes, "Why are you?" I go, "I'm here for business." He's like, "Okay, when are you leaving?" I said, I'm leaving tomorrow." And he's like, "Okay." So, but yeah, I didn't get deported. I did tell my wife that though. So some drunk guy named a town. I don't know how they got to it, but anyways, Patuxahani Phil. You know, he saw his shadow. It says 6 more weeks of winter. Well, apparently there's this massive cold front that's coming that's going to just basically inundate the Northeast. So they are going to get more cold weather over the next 6 weeks. We're going to have some nice weather down in the South for the next week or so. A little bit of rain, but it's going to be in the 60s, so it'll be nice. So starting to get into normal February weather. But Brent posted this. I totally always post little comments on my worksheet in the morning, and it says February, by the end of the month, the sun won't set until 5:47 p.m. By the end of March, it'll be 7:37. April will be 8:30. May will be 9:17, and June will be 9:34 p.m. See, brighter days are coming. So, being very optimistic this morning. You're welcome. Thank you. I appreciate the optimism. We always need a little bit of that. Speaking of optimism, so as I said earlier, kind of in the open, Trump is expected to announce tariffs on steel and aluminum this morning, and we'll see how this happens. And again, kind of what the outcome of this is going to be. Obviously, that's going to impact the cost of steel and aluminum as we deal with that inflationary cost from higher prices. The question is going to be whether or not corporations can pass that cost on to consumers. I'm doing a report for Friday. Specifically, it's actually a 2-part report. It'll be this Friday and next Friday, going through the impact of tariffs during the first presidential term for Trump and what the impact of that turned out to be. Was it indeed inflationary, or was it disinflationary because companies could not pass that on? And here's the big question. We were just talking about, analyzing data for what it is rather than what the media tells you. And again, lots of media out there immediately jumping to the fact that, this is inflationary. This is going to increase the cost to consumers. They're going to have to bear the cost of these burdens. Be real careful with that, because without giving you a complete spoiler alert, that's not what happened the first time around. The impact came to corporate profitability because companies could not pass, they had to absorb those costs, right? Because again, tariffs are on the importer, not the consumer. The importer pays the tariff. So if I'm buying aluminum or steel in order to manufacture a product of some sort, I import aluminum to make aluminum cans, I pay the tariff. The question is can I pass that tariff on to consumers? And we've talked about this before. Inflation is a tax on consumers, right? It is simply the process of companies being able to protect their profit margin by passing on higher costs. So good, if I increase labor cost through some action in the economy, and I now have to pay Brent more for doing his job than I did before, that's an inflationary cost. Now, I have a challenge as a business owner. Can I pass that higher? I'm now having to pay him more for his goods or services that he provides to the company. The question is can I take the good or service that he now provides me and then get my customers to pay that cost by raising my prices? Well, if I can't, if the marketplace does not allow for higher costs to be passed through, I just have to eat it, because otherwise I don't sell my product. And again, this is the important facet when we get down to the very bottom of all of this is consumer choice. And one of the disadvantages that corporations have today is the internet. Because back in the day when, Brent and I were much younger, if you wanted to do price comparison, you would have to go to, say you're going to buy some lumber, right? You'd have to go to a lumber store and, walk into the lumber store and go, well, how much do you want for 2x4s? And they go, we want $1 a linear foot. And then you go, okay, well, I'll be back. And then you drive across town to the other lumber store and go, how much do you want for 2x4s? And they go, we want $1 a linear foot. And then you go to the third lumber store and they go, oh yeah, we got a sell on today. It's 98 cents a linear foot, right? So you've got to, it took a lot of time to price compare to find the best deal on whatever you were looking for. Today, you can do it in seconds just by looking on the internet, right? You can just put into Google or in ChatGPT and say, what's the best price for this product? And it'll tell you who it is and who's offering it. So the ability for consumers to price compare and price shop, especially when they're much more cost conscious these days because of everything costing so much, it makes it very difficult to pass on price. Again, so if I'm the owner making 10 cans in this case, and I try to pass on a 25% tariff, so my can was $1, and I'm now going to charge $1.25, but everybody else is still charging $1. How many people buy my 10 cans? Nobody. I've got to sell them for $1 because that's what everybody else is selling them for. I've got to eat the difference. Or maybe I can sell them for $1.05. Everybody else raises it to $1.05, but I'm still eating 20 cents. And what we found during Trump's first term is that's exactly what happened. Consumer inflation actually declined during his 4-year term because companies had to eat the cost differences from the tariffs that were coming out of China, and that impacted corporate profitability. So the point is to be careful with narratives. Again, a lot of the people promoting these tariffs out there, there's a whole, bevy of media outlets that are saying, oh, tariff bad, Trump bad, this is going to be inflationary. Well, they've got a political agenda also. And they didn't really do the work. And it's interesting because the article I'm writing on Friday, I actually asked ChatGPT, I said, hey, Chat. He said, hey. I said, how you doing? I said, fine. He's got a question for you. I said, what? I said, what happened with tariffs during President Trump's first term? And, again, this is a large language model. So all it does is it just looks on the internet and sees what everybody was saying about tariffs at the time, kind of takes a summation of that and gives it to you. It was wrong. And so what I show in the article is I say, well, this is what really happened. This is what ChatGPT says. And the reason I did that is because that's what the mainstream media is feeding you. But if you actually go do the work, right? Because all this data is readily available, right? You can get it from Fred. You can just go on to Fred and download the data, put it right into an Excel spreadsheet, super easy, and do the analysis. Nobody wants to do it because it's boring. I tried to explain it to my wife, and she just glazed over. She had no interest in it. I invited her to go to the conference with me. It was funny, real true story, by the way. So I'm getting ready. So Saturday morning, I'm the keynote speaker. So I've got to get into the elevator and go down the elevator to this big, giant conference center. And there's probably 2,000, 2,500 people in the audience. This is a big conference. And so I'm going down, and this very nice young woman, she gets into the elevator with me, and she looks over, and I've got my suit on, and I've got this badge to get you in. It's like, one of those security badges to get you into somewhere. So it says, Lance Roberts, speaker, has the barcode on it, security barcode and all that. And so she looks at me, and she glances over, and she goes, you're at the financial conference. And I said, yes, ma'am, I am. And she goes, yeah, my husband's there too. Those things are so boring. And I go, I guess you're not going. She says, no, I'm going shopping. And as she's getting off the elevator, she looks back over her shoulder. She says, just don't be boring. And I'm like, okay, I will do my best. I did my best not to be boring. So I tried not to be, but we actually, went through this. But it was funny because, again, when you start talking about finances, it's boring. I get it. Doing the data and the research is obviously boring as well. But the important thing is, and again, we just kind of go back to this conversation. It's very important as you're investing and this was kind of the key driver of my speech was take these narratives and set them aside a bit and go do some homework. And look, it doesn't matter what your narrative is. Whatever you believe is fine. But see if you can get the data to support your narrative. You and I will disagree on a lot of things. And I get emails all the time with people disagreeing with me. And it's okay, because that's what makes a market. All I'm trying to do is look at the data and say, and this is why we write so much. And again, as I've told you before, if you're not going to our website reading our research work, you're missing 90% of the value of this show, because everything we talk about here on the show, we write articles about with all the data, all the charts. It's all there for you, so you can make your own decision and then invest accordingly from there. But our goal is all to make money, but what makes the market is disagreement. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So just getting ready to kind of wrap things up. Like I said earlier, we're really kind of wrapping up earnings season for the most part. About 80% of the S&P is already reported. There's still a few big companies coming in today. We've got McDonald's. Tomorrow, we've British Petroleum, Coca-Cola. Lyft is another one that's coming in. That'll kind of be one to watch just because of Uber's recent announcements. My nemesis reports on Wednesday. That's CVS Health. And if you don't know my story with CVS, ask somebody in chat. They'll tell you. Someday. Cisco also reports on Wednesday. Robinhood and Airbnb on Thursday. And that's pretty much it. So, I mean, we're down to just really kind of the last few big companies. And, you know, there's a few of the archetype companies like Twilio and, DraftKings, Roku. Those kind of names will report on Thursday and Friday. So again, we're kind of through all the big major names have pretty much reported at this point. So we've got a really good indication about where earnings were for last quarter, for the fourth quarter of 2024. Now, next month, actually in about 2 weeks, S&P will come out with their 2026 earnings estimates. This will be our first look at what they expect earnings to be next year, and I will start tracking it. So I track this every year, and this is how, when we talk about where analysts expected earnings to be and where they actually wound up to be are always two very, very different things. And this year, because of where we are economically, estimates are extremely high. We're still expecting around $250 a share in earnings by the end of this year. Now, that's very elevated above the long-term growth trend of earnings, and also well above economic growth rates. And again, where do earnings come from? Earnings come from economic activity. You and I have to go spend money somewhere for the company to generate revenue. That's what happens at the top line. Then I pay all my expensive, and earnings is what happens at the bottom line. When economic activity is slowing as it is, and we're definitely seeing that in the economic data, it's slowing down. Now, it's still positive, right? We're not in a recession, and there's no sign of a recession at this point, but it is slowing down. We are going to return to somewhere around 2% economic growth over the next year or two. That's very hard to sustain 14, 15, 16% earnings growth in that type of an economic environment. Again, it's not the end of the world by any stretch of the imagination, but again, earnings estimates are still very, very elevated. Now, and this is why when S&P releases their data, we'll take that data and we'll start tracking it. And so every month, actually every few days, S&P will revise their data, and we'll track those revisions over time so that we can kind of keep a track on what to expect. But this is why valuations continue to rise. It's not just a function that the market prices are going up. So, just step back 1 second. What are valuations, right? So when we talk about valuations, those are, measures of different things fundamentally versus the price of what you're paying for them. So you can look at, valuation measures include things like price to sales, which is the price of the market, price of the stock versus the revenue that is generating on a per share basis. PEG ratios, price to earnings growth, how fast are the earnings growth, and how much are you paying for that earnings growth. Most common, of course, is PE ratios. So that's price to earnings per share. So I take the price of whatever I'm paying for, and I divide that by earnings per share, and I can get a valuation of how much am I paying for $1 worth of earnings. So in other words, if I'm only getting $1, and this is the important thing to understand about valuations. If you don't really understand valuations, you just have a cursory kind of view about valuations. And just, they're expensive, but you really don't understand them. What are valuations? What does that mean? So we'll just take PE ratios because it's easy to explain. I take the price that you're paying versus the earnings per share that are being generated by the company. So in other words, if the company is earning $1 per share per year, and you're paying $10 for that $1 in earnings, you have a PE ratio of 10, right? So there you go. Now, what does that mean? Great, I'm paying 10 times that earnings. What that means is that if you were the only shareholder in that company and you collected that dollar every year, if you pay $10 today for that dollar's worth of earnings, in 10 years, you will get your money back. That's what that means. Now, because of the way we've turned markets into a casino, right? We no longer really pay attention to what we pay for earnings. We don't really care about valuations. And that's why we're paying roughly 37 times earnings right now for companies. If you take a look at the S&P. We don't really care about that because retail investors are like, well, number goes up. So I just keep buying stocks because the stock price keeps going up. Don't really care about earnings. You know, we have more companies now that are trading at 15, 20, 25 times price to sales. A reasonable price to sales ratio is 2. If you're paying 10 times price to sales, that means that the company, in order to justify a 10 times price to sales, you can't pay taxes, you can't pay employees, you can't pay for advertising, you can't pay your suppliers for products. You have to take every single cent that comes in from a sale and pass that on directly to your shareholders. That's the only way you can justify 10 times price to sales. But we've got companies trading at 15, 20, 25, 30 times price to sales because we just don't care about valuations now because number goes up. That's the thesis of the market. Valuations matter over a very long period of time. They don't matter in the short term. But we do have to understand some of the basics about what valuations mean so that at least when we're investing, we can understand the risk that we're taking on to buy that company. So if you're paying for a company that has tremendous earnings growth, right? You can pay a higher valuation because the earnings growth will catch up to the price you're paying. NVIDIA has been a really good example of that. Apple doesn't grow earnings and certainly doesn't grow revenue much, but you're paying a very high valuation for Apple. There will be a cost for that at some point. Now, right now, we're into this whole dynamic in the market. It's momentum. It is passive investing that's just feeding 40 cents of every dollar into these stocks like Apple. That keeps prices going up. So as long as number goes up, you keep investing in stocks. But there's a consequence for that ultimately, right? And we'll see what ultimately happens. But there will be some trigger moment at some point in the future. Could be 6 months from now, could be a year from now, could be 5 years from now, whatever it is. But there will be some moment to where investors, something happens, some exogenous event that occurs that causes markets to reevaluate what they're paying for earnings. And if earnings don't meet these rather lofty expectations that are laid out there, and again, this is why we track these earnings estimates as we go forward. The reason we track that is to monitor that risk that you're taking for overpaying for assets. Look, we still own stocks with very high valuations in our portfolio because number goes up. And as I've told you before, I have a job to manage our portfolios, to generate a return for our clients, and try to manage risk along the way. But, if I only buy deep discount value stocks, those aren't working, right? And I won't have a business in a few years. I can justify owning these stocks till the cows come home because they're cheap, they're fundamentally valued. These are great companies. But if I don't generate performance, I'm going to lose clients to somebody who will. This is kind of one of the interesting things people say. Well, Lance, you're just talking your book. Yes, I am. So is everybody. Because when I talk about markets, I talk about how we invest, we talk about how we do things in our portfolio. Yes, I'm talking my book because that's what I believe, right? This is my thesis about how I manage money. So yes, I am talking my book. And so is everybody else. I mean, anybody that's espousing an opinion on the financial markets of whatever it is, they're talking their book because that's what they believe. And if you're a small cap value investor, then you're talking small cap value, and that's what you believe. And yes, you're talking your book. This is just the way the market works. So this is why, this kind of goes back to our whole conversation this morning about doing homework. And this is why if you're going to invest your capital, you need to be able to do some very basic fundamental homework to help you navigate the risks that you're taking. You just need to understand. It's like, look, inherently when we drive a car, we know that if we're driving really, really fast above the speed limit, that we have a risk of either getting pulled over or getting into a crash. So we're more attentive about watching the sides of the roads or just over the horizon to see if there's some police cars sitting on the side of the road, right? You're more attentive to that than you are if you're driving the speed limit. Same thing in investing. It's okay to take on the risk. Just make sure you're paying attention to the warning signs. All right, wraps up the show for the day. Get by the website. We'll be back tomorrow. I'll have an article for you talking about markets from the technical view to make up for this weekend's newsletter, which will return in full this weekend on the website. Make sure you're subscribed, realinvestmentadvice.com.